Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks so much for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. So nice to have you back with us. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can go to TomWilsonProperties.com to sign up for our newsletter on economics and real estate. Also, by so doing, you'll get access to our commercial syndication products that are only made available mostly to our listeners and to our clients who sign up to our website. We always welcome your questions, and we're glad to answer your questions and take your suggestions for topics and guests to have on the program moving forward. So today we have a very accomplished real estate investor and educator, Jason Hartman. He's a successful real estate investor, author, speaker, podcast host, owns property in 11 states. Right? We always like folks that practice what they preach. Right? He's the president of Platinum Properties Investment Network and Hartman Media Company, producer of 15 podcasts and 11 books, including Creating Wealth, Real Estate Investing Show. And he has also started the Jason Hartman Foundation to provide financial literacy for youth. And it'll be the first time I think we've had Jason on the program. Jason, welcome.
Tom, thank you. How are you doing today?
I'm doing very well. What an exciting world we live in, huh? It sure has its share of problems, but by golly, we have lots of resources to come up with answers and take advantage of the world that we live in, from preparing ourselves for what's down the road, and so glad to have you on board today to talk about your story and what you do.
Yeah, I concur with you, Tom. I always say it's an amazing time to be alive. Technology feels like there is a sort of a hockey stick progression. I mean, you're right in the heart of it there in Silicon Valley, obviously, but just such amazing ways the world has come together, and the network effect of all of this knowledge that people are sharing that they've never been able to share with each other before across time and space has really transformed the entire world and dematerialized many parts of the world. So there's a lot of stuff to be grateful for and a lot of amazing things going on. I just want to, stick around to see how it all turns out. I'm just curious, if nothing else, to see where.
There's part of me that thinks, by golly, by now everything that could have been thought of must have been thought of. But the more there is, there's just an increased perturbations, right? So, Jason, what led you into real estate?
I grew up in Los Angeles, California. I was poor, and I didn't like being poor very much. When I was 16, I saw an infomercial, and the real estate guru was on there talking about his latest book, and I went out and got his book, read 3 chapters, put it down. My mom picked it up, and about 2 years later, as I was getting ready to graduate from high school, I was 18 years old. My mom says to me, Jason, you got me interested in this real estate stuff. There's a seminar this weekend that was one of those weekend pitch fests with a lot of different speakers. Yep. You know the type, Tom. We all know it.
Oh, yeah. I've been to many of them.
Yeah, I have too. And it was by Disneyland in Anaheim, and my mom says, why don't you go? So I rounded up 9 of my friends from high school, because at that age I couldn't do anything by myself.
Wow.
And I got them all to go with me, and by the first night, Friday evening, I was seeing the speakers, and I had all 9 of my buddies there. By Saturday morning, only 1 was left. All the rest went to the beach. By Sunday at 5 p.m., I was the only one that made it through the weekend. And, I remember, Tom, one of the speakers talking about points. And I thought, what are points? What is he talking about? Loan points, of course. And
right.
I remember I discovered Earl Nightingale about a year earlier, and he and the three other famous motivational speakers of the time, Zig Ziglar, Dennis Waitley, Earl Nightingale, Jim Rohn, they changed my life completely. And I remember Earl Nightingale on one of his cassettes saying to me and everybody listening, he said, if you want to get rich in real estate, why don't you just learn the business first? And so I went to Century 21 Real Estate School, got my license my first year of college, and started selling real estate. And then about 6 months later, I bought my first rental property at age 20 in Huntington Beach, California. So that's my story.
At 20 years old, wow. And then you look at the stats for real estate agents across the country. And the last stats I read said that only 2% of residential real estate agents ever invest. Isn't that a sin? Isn't that awful?
That is a terrible. That's a really sad fact. But yeah, I certainly believe it though.
Yeah, I guess it's the same old story. The plumber's own house is the last one to get repaired with a sink.
Yeah. Well, shoemaker. Hey, listen, sometimes I feel like the shoemaker who won't fix his own shoes. I'm so busy doing it for clients that I don't spend enough time on my own portfolio, but it's always a balancing act, isn't it?
Let's talk a little bit about some nuts and bolts here of the current economy, and then maybe at the end we can chat a little bit more about kind of the global perspective of these things, which clearly
Sure.
you have an interest in. Let's look at some short-term impacts of various things going on in the world. How about the new tax plan that has come through? Do you have any thoughts about how that's going to affect home ownership rates and so forth?
It's a pretty. I think the I'd call it the Republican tax plan. I used to say it was the Trump plan, but it's been watered down quite a bit from where Trump wanted it to be. But I think it's going to have a pretty significant impact on the economy in a very positive way. I think it incentivizes a lot of the right behaviors, but I do think it's going to produce less of an incentive for home ownership. Certainly at the high end, the high end home buyers have lost 25% or so of their deduction on mortgage interest. Mm-hmm. So yep. I think we'll see a reduced incentive there. As far as the investment side, not too much of a change, but you always got to look at things about three steps back, right? And if money flows out of home ownership, a little bit might flow out, right, because of the reduced incentive there. But with the overall broader strength in the economy that I think the tax plan will create, and the repatriation of some money to the U.S. that's been overseas, in the big company coffers and so forth, I think overall it's going to be a good thing. But I think the next 10 years, Tom, we are going to have a very strong rental market. The demographics coming at the rental market over the next decade are potentially the strongest they've ever been in history, or at least since we've been keeping track, because the Millennials, huge demographic cohort, 1 million strong, slightly bigger than the baby boomers. A lot of things will be impacted by them, and I'm sure we'll get to that during our talk today. But overall, I think the tax plan is positive. I think it's a good thing.
Do you think? So it sounds like you feel that the reduced deductions and advantages of the higher end houses is going to cause maybe a little bit of compression of prices of houses across the country.
I don't want to say it'll cause compression because there are so many other factors, but it creates a little bit less of an incentive, a 25%-ish, give or take, less incentive on the mortgage interest side. Sure. Also, of course, with the $10,000 limit in the SALT part of the plan, there's an incentive to leave overtaxed states like my home state, California, places like New York City. I was just in New York City, spent a week there. I hosted an event there. And, you see a little bit of flight of capital in these places. There's a lot of inflow too. And, of course, where you are, you're sitting in the venture capital of the world. So it's sort of hard to say that in Silicon Valley. But I think, I think there has been a bit of a middle class exodus from high tax locales as technology has made the population more portable and it's more easy to move and work from anywhere than ever before in history. So a lot of factors influencing this.
Yeah, a lot of people say, "Oh, Tom, you've bought and sold thousands of units in the state of Texas with no tax. Why are you still in California?" And I guess after 49 years, I kind of like living here. I don't like the politics, and I don't like the over-regulation. But again, we can. Right, we're not restricted to buying next door. We can invest wherever it makes sense. So with the virtual world that we're in, it's pretty easy, and having feet on the ground with all your team members everywhere. But that could. It's last decade. There's been 62 corporations that have moved their headquarters from California to Texas just because of those kind of incentives, and that's even before this new tax law.
You'd think our old Governor Moonbeam from the 70s would think this is a problem, but apparently he doesn't think much about it, does he?
No. And I think he's more conservative in his older age here than he used to be. But whatever. I guess we're not going to solve that problem on this program today. Before we just got about a minute left in this segment here. Any thoughts about? So you're kind of bullish on tax cuts, and of course the theory always is that if you reduce the taxes, then you stimulate the economy, and you'll wind up with more total revenue downstream. And of course the critics say, well, you'll never replace it. You've lost too much revenue, and you won't stimulate enough to. Can you talk to that for a moment? What your thoughts are about that?
Well, this is the old Arthur Laffer, the Laffer Curve, and the supply-sider discussion. And, I believe that when you reduce the tax burden or the regulatory burden or both, you stimulate economic activity. Money doesn't sleep. Even if it is hoarded, so to speak, Tom, it's always doing something. It has to work. It always works, and capital formation is wealth creation. In any society throughout history, you've got to have capital formation. If it's in the hands of the private sector, I think it's better used than in the hands of government.
Yeah, private sector tends to be a little bit more efficient, and let's face it, we got the incentive to reward those that take risk and invest it. So I think that's. Let's hope it plays out that way. Different times in the past, sometimes it's worked, sometimes it hasn't, but I'm hopeful that it is too. We got Jason Hartman on the program today, real estate investor, author, speaker, and podcast host, right here on Real Estate Radio Power Investing. So stay with us. We'll be back in a bit and ask Jason some more questions about where he thinks things are headed in the economy and about real estate investing. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Very pleased to have Jason Hartman with us today, a real estate investor, author, speaker, and podcast host, who's an investor in multiple states. And we're talking about the economy and how the different aspects of the changes in the economy might affect real estate and real estate investing. Jason, looks like we're going to have some more interest rate hikes, although I think pretty slowly. What's your thought? Do you think that's going to have any impact on real estate and investing?
Oh, yes, most definitely. I couldn't agree more. But I do have to say, Tom, that I have a pretty good track record at making a lot of predictions, but one where I have fallen short over and over again is interest rates, because I thought rates would be higher a long time ago, and if it wasn't for this intervention from
the Fed. Well, you keep thinking free market, right?
Yeah.
You keep thinking about what makes sense.
Yeah, what makes sense doesn't work in today's world. There's so much market distortion with all the intervention, but certainly, the Fed has declared, and this is not the same sort of opaque Fed we had under Alan Greenspan. The Fed has declared that we are going to see at least 3, maybe 4 more hikes. And of course, they don't control mortgage rates directly, but they do indirectly. And so I think we will see an overall cooling eventually, but I think it's going to be a nice soft landing. I think if anybody's concerned about a market correction, look at about 2 years away, about 2020 for that. But again, nobody knows. The business cycle is notoriously hard to predict. Even if people say they can predict it, they eventually fall on their sword.
By the way,
it's a tough game.
By the way, we just had Dr. Doug Duncan out for an event that we were talking about before the program started, and he's has called every one of the interest rate hikes correctly so far. And just FYI, and to our listeners, he's predicting that we'll have one more. We'll have one in June, and then another one that might be in December or slide out into the new year. So
right.
So,
now, the interesting thing, Tom, is when you talk about Doug Duncan, and I mean, he's obviously in the catbird seat, right, with Fannie. But what's interesting is that and people would think that rate hikes are bad, right? But landlords that own a lot of properties and have long-term fixed-rate mortgages on those properties, they actually like higher rate environments because
they benefit from it, because it's relative.
You
Very
see
good
the
point.
increased rents. You see a lot more upward pressure on rents as housing affordability declines. People only really have 3 choices, right? They can buy, they can rent, or they can be homeless. And when I said that at a live event at one of my conferences recently, someone raised their hand and said, no, they can live with their parents. Well, yeah, you're right. That's the millennial boomerang generation, isn't it? But ultimately, it's a buy or rent equation, right? As we all know, it comes down to that at some point. And upward pressure on rates means upward pressure on rents, so it increases cash flow.
Doug quips that they did a survey last year, and they asked parents what did they love their kids enough to let them come back home. And if so, how long would they love them? And the survey showed that most would have their kids come back home, but about two years was about good enough.
Right, exactly. And in the old days, 2 years would have been too long. So parents are pretty generous nowadays with that.
And speaking of kids coming back home, millennials here, there was a kind of a philosophy that millennials weren't going to buy, right? And so they certainly delayed house formation, but that seems to be changing a bit.
It is. You're right. It is changing a bit, but I would argue that that's only because their numbers are so large. I mean, you've got 80 million people in that demographic cohort. It's a big number, right? So overall, yes, they've basically, the millennial generation is the first generation to have a mortgage without getting a house included, and that's called a student loan. So they're saddled by huge student loan debt. They view themselves as a much more portable generation. They grew up in the sharing economy, Lyft, Uber, Airbnb, et cetera, et cetera. The ownership society concept is, I think it's less meaningful for them. They just
Interesting.
look at
Good point. We got to stop. We got to take a break here, Jason, and we'll continue that conversation when we get back on Real Estate Radio Power Investing with Jason Hartman. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We have Jason Hartman with us today, and we're talking about the impact that millennials are having on and will have on real estate investing. Let's continue that conversation, Jason. What are your thoughts? You mentioned that there's there's now starting to buy, but it's a very, very large portion of the population. So it's something it's important to watch carefully.
Absolutely. It's a large group. It's 80 million strong, slightly bigger than the baby boomers. So they are starting to buy, but compared to what is the question to ask, Tom? And that is, they're delaying family formation. Household formation is later in life for millennials. They're a much more portable thinking generation than any before. A lot of them were in their formative years when they saw their parents get burned during the Great Recession, lose their homes, et cetera, et cetera. And, the one thing I always say, too, is unemployment's obviously very low now, but when you look at underemployment, I would argue that things are not nearly as good as they might seem, although they're better than before. So it's you got to peel back the onion a few layers, obviously, to understand it. But there's a lot of underemployment out there, and the best thing anybody can have on a resume, Tom, is mobility. Mobility is the best thing you can have on a resume, to be able to move to where the jobs are, to move to where the opportunities are. And certainly we're seeing that with millennial generation moving to places like Salt Lake City, Denver, and Nashville. Nashville's really hot right now too. I call it the new Austin, right? And as they're doing this, they're just not. The whole concept of buying a house with a white picket fence, it just doesn't live for them the way it lived for prior generations. I'm not saying it's unimportant. I'm just saying it's not as big a deal as it used to be. And so that's really changing things, and it bodes really well for investors. It bodes really well for the rental market. This is a giant marketplace of 80 million people that needs to be served. And you've got investors listening to your show, Tom. They're listening to my show, and I tell you, it's an amazing time to be a real estate investor and have rental housing that you can provide to these people. And then on the flip side, the baby boomers are renting more than ever before. That's been a bit of a surprise too. They're empty nesters. That they want to live in kind of happening city places and college towns many times, and renting doesn't sort of have a stigma like it used to. It's just a more popular option nowadays.
And I think boomers now tend to be healthier at an older age. They're more active, so they're still engaged in the marketplace, impact the economy in the marketplace.
Yep.
As well.
Yeah.
And for those that don't move, who stay. For those that don't move and stay in the house, then they're generating some economy because they're remodeling the house extensively to stay there.
Sure.
I mean, certainly in places that are vibrant, like where we are here in San Francisco Bay Area, it's hard to find a contractor to show up because they're so busy renovating.
They're too
housing.
busy, exactly.
Yep. And and we've got these millennials. Even though you mentioned that on the resume, it's good to have mobility, and so that's a new kind of a new paradigm, right? It used to be that the mobility was viewed negatively by an employer, but
right.
In this world of virtual employment and virtual assistance and being able to operate from anywhere, it doesn't make as much difference as it did before. We've got Jason Hartman here on the program with us today, talking about real estate investing and a lot about how the economy and changes in the economy and demographics are affecting that. So we'll be back and chat some more with him about these important issues in just a moment here on Real Estate Radio Power Investing. So stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We're fortunate to have Jason Hartman with us today, a real estate investor, author, speaker, and podcast. Investor in many states. So, Jason, how do you go pick markets that you like to invest in, and what are some of your favorites today?
Yeah, great question, Tom. We like linear markets. You can basically sum up every real estate market on earth into three major categories: linear, cyclical, and hybrid. And the linear markets are the markets that don't get in the news very much. They're sort of calm and consistent. It's kind of that old thing about the tortoise and the hare, right? The linear markets are just good cash flowing markets. I know they're markets that you like, so I know we'll agree on this in many ways. The cyclical markets are the high flyers. Those are the ones that are always in the news. They're just amazing bidding wars, prices going through the roof or crashing through the floor. They're more like a roller coaster if you're looking at a chart.
If you catch those markets at the right time to get in and get out, boy, you sure look like a genius, don't you?
Oh, yeah. Well, everybody's a genius in a bull market, right, Tom?
Yep.
Yeah, absolutely. And then the hybrid markets are in between the two, as the name would imply. So the cyclical markets are virtually the entire west coast of the United States, the expensive northeastern markets in South Florida. Those are the cyclical markets. Around the world, there are places like Hong Kong, there are places like London, Dubai, et cetera. So these are trophy markets, right? And they're markets that just the cash flow just never works, and the cycles are just very unpredictable. So I used to be in those markets. I grew up in those markets, spent most of my life in those markets in Southern California. But I don't like those markets being a little older and more conservative nowadays. I like the good old linear markets, places like Jacksonville, Indianapolis, Jackson, Mississippi, Little Rock, Arkansas, Northern Indiana, Memphis, Dayton, Ohio, the Quad Cities, Fayetteville, North Carolina. These are kind of boring places, but they're good and consistent markets.
Boring can be good. That's the old tortoise, huh? Yeah.
It can be good. Yeah, it can. Absolutely.
Yeah, and that's and indeed that's why I picked years ago. I guess 19 years ago now. I picked. Texas cities, like say.
You made a good pick with that, by the way.
Consistent growth. Yeah, that was great. I was looking for consistent growth with a history of not having much, severe down cycles. I wanted to protect my capital, but be cheap enough that they could cash flow. And boy, was that a good decision to pick a linear city like that.
Yeah, I couldn't agree more. I know you've done a lot of work in Dallas, and Dallas has become a hybrid, by the way. We've done hundreds of transactions in Dallas over the years and loved it, but it's gotten a little too expensive for us now, and the cash flow doesn't work so well, but it's a great place, no question.
Yeah, we got cap rates and as you know, I've kind of moved from the single-family home business to the commercial, which includes multifam, and we got cap rates and now in Dallas that are under 6% in multifam, so that's why we tend to stick to. Now we've moved from that asset class, which has become weak. Yeah, we've moved from that asset class over to the non residential in those cities where it's become tough and you got cap compression. Let's see. Talk to me a little bit about. Do you think we've got think we're building up another bubble, or are we just plain continuing to increase in value and prices because we just have such a supply shortage?
Well, that is the million-dollar question for sure. That is the million-dollar question. And I think both are kind of true. I think in the cyclical markets, we have already passed the point of fundamental value by a pretty big margin. However, that doesn't mean that a crash is imminent. So I would be very cautious in those markets, in the cyclical high-flying markets, over the next maybe year and a half, 2 years. I would be worried if you're trying to be a market timer, and historically the market timers have never done very well on the long term. In the short term, they can have some real successes. Like we said, everybody's a genius in a bull market. But in the linear markets, I think those markets aren't very susceptible to big fluctuations, Tom. So I think you're pretty safe. It's a pretty safe bet. Prices, and that's the metric everybody looks at and thinks about, are the prices up, down, sideways? But what they don't really think enough about is income. Income is really the more fundamental, more reliable, more predictable thing. And even in a declining price market where you have properties depreciating, income is pretty consistent. You know, in the linear markets, people don't watch the clock, as it were. You know, they don't think too much about the cycles. They just think about getting good yield, good cash flow, good cap rates, you know, just good income. That's the fundamental thing of real estate. You know, slow and steady wins the race, I say.
And when you refer to income, are you talking about the investment property income, or are you talking about people's employment income?
Oh, good. Well, thank you
both.
for asking that. No, I'm talking about the rental income from the property.
Right.
Now, of course, in those markets, though, it's really good that you brought that up, because in those markets, I think the overall economy is more stable as long as you consider some other factors, like, you know, having a diversified employment base, many industries, et cetera. And many of these places in the past, decades ago, had sort of monolithic employment markets, but they're much more diversified nowadays. You know, I remember hearing the stories of Houston, you know, the billboards along the freeway that said, you know, in the 80s, that said, well, the last person to leave Houston, please turn out the lights. You know?
Right.
And that was when the economy wasn't very diversified like it is today.
Yeah, and I think that's kind of I think that tends to be the trend in a lot of folks, a lot of cities, even places that used to be one-horse towns, as I like to call them, and they tend to broaden the economy as time goes on. A lot of people think Texas cities are mostly tied to oil, and they were at one time, but they're certainly a lot more diverse now. We'll have Jason back here right after this last break to do a little summary for us and tell us a little bit about his Jason Hartman Foundation. So stay with us on Real Estate Radio Power Investing. We will be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Jason, it's been a pleasure to have you on. Jason is a real estate investor in multiple states, author, speaker, podcast host. And before we just wrap up here with a little bit of summary, Jason, if people want to contact you or get more information, how can they do that?
Oh, thanks, Tom. They can just use my name. Just go jasonhartman.com, JASONHARTMAN.com. And they can also check out my podcast on iTunes or any of the podcast platforms by just typing my name in the iTunes store, for example, and they'll find the Creating Wealth show. And got a lot of good information, a lot of great guests on that show over the last 13, 14 years. I've been podcasting for a long time.
Wonderful. So tell me, what's the Jason Hartman Foundation?
Yeah, the foundation's something I started. I had a traditional real estate company that I sold to Coldwell Banker in 2005, and I always wanted to do something that would, have a lasting impact beyond myself. And so I started a foundation. We don't accept any donations. It's strictly my own money that I'm just giving away to causes I like. And the major cause originally when I started the foundation was financial literacy for young adults. I was a junior achievement volunteer for 3 years, and teaching junior achievement for an hour a week in the economics class in high school. I just realized that these kids, just like myself, it was the same thing for me. You go through all this education, you get to 12th grade, and you still don't know the basics of personal finance. Should I buy a car? Should I lease a car? How do I buy my first house or my first investment property? What does inflation mean? What impact does it have on my life? So the Jason Hartman Foundation publishes its own podcast called The Young Wealth Show. And that's, of course, available on iTunes and all the podcast platforms, too. And then it donates money to various financial literacy causes that impact young adults. And in addition to that, it's broadened its scope over the past few years. It's into First Amendment issues and free speech and things like that as well. So, I'm, just just am looking for ways to give money away in a good sort of organized fashion. That's it.
That's wonderful. I've had the pleasure over the last 16 years or so getting to know Robert Kiyosaki pretty well. And at one time, he was noted for promoting the house investing and so forth. And as time has gone on, he's really focuses on financial education, and it really frustrates him that it's not something that's taught in schools. So, Jason, thank you for being on the program with us today. We'd love to have you back on and talk some more. If you'd like to go to TomWilsonProperties.com. You can sign up for our weekly newsletter on the economy and real estate trends, and you can also by registering, you can get access to commercial syndications that allow you for $50,000 a share, typically, to invest in products that normally are reserved for institutional and REITs and large investors. So. We again always welcome your input and your questions. So thank you, Jason, for being with us today, and thank you, listeners, for being with us. We look forward to having you back on our next program, and we look forward to having you back, Jason. So remember, the only thing that matters is what you do next.